No one likes to watch their stock portfolios crash and burn, and the thought of buying growth stocks in our current economic climate may be the last thing you want to do, but could there be some massive upside to doing so? In today's video, we're taking a look at one growth stock ETF that might be perfect for massive growth in 2023. I'm Sean with The Modest Wallet, where we make money simple. Thank you so much for checking out our channel, and more specifically this video, we are talking about growth stocks and more specifically a growth ETF. Now let me back up just a bit for those who may be new or lost with what a growth ETF is in the first place.
I'm confused.
A growth ETF is a collection of stocks. That's the ETF part, otherwise known as an exchange-traded fund. The growth part includes the companies that are anticipated to grow at a rate significantly above the average growth for the market. So when you put those two things together, you get a fund you can buy just like you can buy an individual stock on any brokerage. And just so you're thinking about it, it's comprised of growth companies. So that fund doesn't have any other types of companies, it has growth companies. Let's talk about the pros of growth ETFs. One pro of growth ETFs are the high rates of return during favorable market conditions. Growth stocks have above average rates of return during these times. Another pro for growth ETFs is they typically include companies involved in the latest cutting-edge technologies. Lastly, growth stocks typically pay little in dividends and offer investors returns through capital gains. Individuals not seeking income but rather growth from capital gains will appreciate this. Now, there is one con that stands out to me. So one major con of growth ETFs is that they tend to be very volatile in the short term and involve a higher level of investment risk. Now that we've learned a little bit about growth ETFs, let's talk about the specific one we're going to be focusing on today. And that one is the Vanguard Growth ETF, ticker symbol VUG. This fund seeks to track the performance of the U.S. Large Cap Growth Index. It provides a convenient way to match the performance of many of the nation's largest growth stocks, and it follows a passively managed full replication approach. Let's take a look at the portfolio composition now, and you can see on the screen that this fund, VUG, is made up of 247 different growth stocks. So you're getting that diversity there, obviously. Obviously, they're all growth stocks, but you're getting a bunch of them in a basket, which is something I always love, and one thing I love about ETFs. I'll share with you a couple other numbers that might be interesting to you. I'm not going to go into too much detail with them. I do want to just kind of draw your attention though. The fund total net assets is over $144 billion. Now, if you look at the style box, just to kind of give you an idea of what kind of stocks we have in this fund, and I think you're going to already know that, but we're looking at more of the larger companies, and once again, those growth. So you can see it highlighted on this chart in that large and growth area. Now let's get into some of the exposures that this fund has. So VUG does touch all of those 11 sectors of the stock market, but now let's take a look at what percentage each one is contained in this portfolio. Basic materials, 1.6%. Consumer discretionary, 23%. So pretty big there, pretty big piece of the pie, but there's another one coming up. Consumer staple, pretty low in that area, less than 1%. Energy, 1.7%. Financials, 2.8%. Healthcare, 7.9%. Industrials, 11.5%. Real estate, 2.6%. Technology, this makes sense because it is, a lot of those companies are growth stocks. Technology makes almost 50%, coming in at 46.6%. So that is a huge chunk. And then telecommunications, which is 1.2%. And then a little bit of utilities, not much, 0.2%. And continuing looking at the composition of this fund, I'm not surprised here as we look at those top 10 companies. not surprised to see a bunch of the information technology companies or the tech companies. Apple coming in at 13% of this fund is in Apple. Microsoft making up 11%. So those two taking up a big piece of the pie. And I have to say I'm okay with that, even though it's a lot. They're two solid companies, and they do similar things, but they have, each of them owns different aspects of their market. Amazon coming in at 4.85%. Google, there you see GOGL and GOG, the different classes, totaling a little over 6.5%. Then there's Tesla coming in at a little over 3%. Nvidia is coming in at 2.33%, a chip maker. Visa coming in at just under 2%. Home Depot 1.93%, and rounding it out is MasterCard. Vanguard does like to list their risk scale, and so you can see it does come in as a 4, much like VTI and VU. So I consider this a little more riskier than VTI or VU, which we've mentioned in past videos on the channel. But anyway, it's still coming in about the same. If you look at the expense ratio, and I'll go over this a little more, but 0.04%. So we're talking 40 cents, literally 40 cents on every $1,000 invested. And then if you look, the 0.67% for the yield. Now that makes complete sense, because these are primarily, or they pretty much are all growth stocks, and growth stocks tend to not have a dividend, and if they do, it's usually on the lower end. So I'm not surprised to see less than 1% in the dividend yield. So when you invest in growth stocks, you're not investing for that income or for that dividend. This stock's or ETF's price is $214.54 as of 12/19/2022. So if you're going and looking then at that dividend, going back to that dividend, as I said, it does pay a quarterly dividend. It's not much, but if you look, it has paid a quarterly dividend, and we're looking at anywhere between about 30 cents and 42 cents per quarter per share. So that is a pretty small amount, but once again, you're not looking necessarily for a huge dividend yield or that income or that payment that you get from the income. And you will, if it's not in a taxable account, you will get taxed on those dividend payouts. And for anyone wondering, that ex-dividend date is the date that you need to own the stock in order to get that quarter's dividend payment. Now, I think this is really important to look at, obviously, and this is the annual returns. So if you look at that year to date, which means from January 1st to the date that we're currently at, it came in at just under 27%. So then when I say just under 27%, I'm talking a negative 27%. So obviously the S&P 500 is since January 1st, it's down closer to the 15-16% range. So 27% obviously does hurt a little bit more, but as we've already mentioned, and we're going to mention again, growth stocks tend to do much better than the average, but they can also do a lot worse during downtimes. Then looking at the 1 year, it's down about a little over 25%. If you look at the 3 year, things change a little bit, and you can see that annual percentage is a little over 10%, which is what we like to see. I personally like to see that anywhere in that. Anything over 10% is great in my opinion. 5 year, it's 11.74%, and the 10 year, it's up 13.81% annually. Since inception, 9.67. So a lot of positive things over the long term. Although the Vanguard Growth ETF is currently down nearly 30% over the past year compared to the S&P 500's 15% decline, it's up roughly 354% since its inception in 2004, while the S&P 500 is up around 250% in that time frame. Whether or not you'll be able to double your money in 2023 will depend largely on how the overall market performs in the upcoming year. But if the market rallies, you could see significant returns in a relatively short period of time. Investing is a long-term strategy though, And if you give your investment several years or even decades to grow, you could make a lot of money over time. If you do choose to invest in this ETF, double check that the rest of your portfolio is well diversified. And this is because high growth stocks can be riskier. Thank you so much for checking out our channel. If you found value, please smash that like button, and don't forget to check out our blog over at themodestwallet.com, where we also try to make money simple. Also, don't forget to check out all of our other investing videos, and I'll see you in the next one.